We had built the website to collect subscriptions, but we had not built the pipes. Now we've collected enough pledges to fund this first loan. Then we had to go to investors and say, hey, on this thing you pledged, and then the funniest thing is when we finally got the money, I actually had to take a cashier's check from one bank and walk down Faneuil Street with this $80,000 check and deposit it in this other bank. It was humbling, but at the same time, I was kind of proud.
Brian Daly is a pioneer in private market investing and one of the earliest category creators in real estate debt investing. As the co-founder and CEO of Ground Floor, he helped open a new chapter for self-directed investors who want access to high-yield, short-duration opportunities backed by real estate. Before Ground Floor, Brian launched Republic Wireless and spent years building customer-first companies at the intersection of technology and finance. Over the last decade, he's been shaping a movement that challenges traditional capital markets and brings ordinary investors into a space once reserved for institutions. Today, Ground Floor has grown to hundreds of thousands of registered users who have placed more than $1 billion into real estate in the private market. Brian has become one of the strongest voices in the maturation of this asset class, the evolving sophistication of retail investors, and what the next era of private market participation will look like. Brian, welcome to the show.
It's good to be with you. Thanks.
So let's talk about your founding story and just your initial early fight for credibility. Your founding story, it includes a lot of early resistance and an uphill climb. What originally convinced you that private market real estate debt could be a category worth creating?
Well, it was the combination of two key things. And I think every entrepreneur who starts a business and has an idea, needs, I think it's beneficial to have a partner who complements you well, and to have a long-standing interest in whatever you're doing. And in my case, I became an investor at age 15, investing my summer earnings in mutual funds, which you had to go to the library to learn what a mutual fund was. And my dad sent me there and he said, look, if you go learn what this is and you sock away some of your summer savings, he matched every dollar, and I stacked up quite a bit of investment. And
this is fantastic.
I pursued it as a hobby. I always loved it. Picking stocks and, playing around with different strategies over time. And I was a real hobbyist. And I think when I started to look at the landscape of finance and think about different ideas for tapping into the investing world, I had the good fortune to meet my co-founder, Nick Bargava. Nick is a visionary in applying regulatory securities law to novel use cases in capital markets. And when I met Nick, he had just completed some time in Washington, D.C., lobbying for and helping to write the 2012 Jobs Act, which legalized sort of investment crowdfunding, if you will. And so he really was back then one of a small group of people that was thinking about this space. And Nick had a lot of great ideas about how to build mass market product. So I think that was the start. It was the combination of my interest in investing and Nick's expertise and vision for how regulation could be used to open up this market. And I think because of who we were, we had a very different sort of outlook on the market that served us very, very well. And I think helped us to break free from the pack in a space where a lot of similar companies, or at least companies that sound similar, haven't made it.
When you look back on those early years, as the Jobs Act was still a bill being constructed in Congress, what was the vision you held on to before anyone else could see it?
Well, as an entrepreneur, I am oriented around building mass market experiences. When I was in the wireless industry, we built browsers for mass market phones before smartphones were a thing. I've always been attracted to opportunities that sort of take something that's rarefied and for the few and opens it up to the many. So I think the opportunity for us Well, look, was it obvious that a business could be built, formatting alternatives for individual retail investors the way that we did it? No, it was not obvious. We had at least 10 or 12 law firms tell us that the SEC would never let something like this see the light of day. We broke through that. Were we early? For sure we were early. I think it's kind of obvious now that retail investors are important. But it wasn't obvious then. And a lot of people said, well, why are you bothering with kind of the small investor? And the non-obvious benefit of doing that was that we built a very different type of product and a very different type of company that became anti-fragile. And that was proven over time. There were a lot of non-obvious things that we didn't know when we started, right? But we held on to that idea that it should be a mass market product. And we alone, out of anybody in our space, had the temerity to kind of go through the regulatory process, format our product to work within the regulatory construct so that it could go to everybody. And it cost a lot of money and it cost a lot of time, and a lot of people kind of made fun of us, for the strategy, but they're not making fun of us now.
I love it. Let's talk about creating a new asset class, or at least bringing a new asset class to the private market investing. Does Ground Floor see itself as a category creator of real estate debt investing?
Well, for retail investors, we are the category creator for real estate debt investing. There is no other way to invest in real estate investment debt in this format with this particular range of mechanisms. And we've evolved, the vehicles, right? Just like the public market, public market investing went from individual stocks to mutual funds to index funds, ETFs, right? I think alts is going to go through a very similar sort of evolution, and we have led the way in real estate debt. What's interesting about real estate debt is that we discovered a capital market that exhibited certain characteristics that made it great as a beachhead. But what we learned about capital markets from the specific case informs us that this can and should and will be done in half a dozen or a dozen more markets for the benefit of the retail investor. And I think it needs to be done in a certain format, in a certain way that not many people really understand yet. And I think we're as well positioned as anybody to sort of show the way on that. So yes, category creator in that space, but for the purpose of proving a larger point that now I think the company's set up to go execute on over the next decade or two.
What made this the right category at the right time for retail investors?
Well, look, real estate investing is an aspirational asset class, right? People have the idea that that's how you build wealth, is real estate investing, whatever that means to people, right? Whether that's just investing in a public REIT or buying a rental property or whatever it is, people have this idea that real estate is how you build wealth. So it's an aspirational asset class. It's also one that's tangible. So if you look at a lot of other alternatives, collectibles and other things, like they're more or less tangible. Many of them aren't tangible at all, right? So real estate is something people can feel and touch, and they know it has value. And when people start talking about tokenization, they're very excited about tokenizing real world assets. Well, what's a more real world asset than a building, right? Like that's pretty real. It's in the world. And so I think the combination of it being an aspirational asset class and then something that's tangible, real estate debt is not something that people really understood, right? It's sort of like, what does it mean I'm investing in the debt? And once people try investing in debt, they realize they're actually probably the yield on a lot of the real estate debt that we offer returns more than you would earn as an equity investor in a similar sort of asset, right? If you invest in rental property, on some platforms that are out there, the yields on that and the returns on that on 90% of those properties are lower than you would have gotten just investing in short-term real estate debt, right? And that's not obvious. People are like, what do you mean the debt returns more than the equity? And it's because of some of the dynamics of this market. So we've had to orient people around debt and show, it exhibits this really low volatility, with a high yield that's very uncommon in investing. It's unlike anything else in my portfolio, frankly. And I love it, right? I love it as an individual investor myself. And I think the reason people like it is they get the yield, they get the asset class, and then the volatility is really low. So you kind of understand where it's going to perform with some reliability.
Let me dig into one more question on that. What is it that you think people still misunderstand about real estate debt compared to other private market
Well, they
opportunities?
just don't understand the difference between financing a loan and being a creditor and being an owner, right? So in general, people, when you're investing, people think, well, I'm investing to own something. And that appeals to people, right? But when you're an owner, you bear all of the costs, you bear all of the risk of the asset appreciating in price or depreciating in price. When you are a credit provider, that's why banks make so much money, right? They borrow money from depositors at really cheap rates, and then they turn around and lend it at very, very high rates, right? People owe them. There's a loss against every loan portfolio and whatever else, but the losses tend to be very low when the loan is secured by a property, right? You can really underwrite the loan to limit losses over time, and that's I just don't think people get that, right? I mean, getting to step in the shoes of the bank is kind of a mind-blowing proposition. So like, wait, I'm going to make the returns that the bank would make.
That's not bad.
Yeah, you are going to make that.
Let's talk about the evolution of retail investors across your career here. You have a front row seat to how investors have changed over 12 years. What shifts are you seeing in the sophistication, readiness, and expectations of everyday investors entering the private markets today?
Well, look, I think people love dismissing retail investors. They've done it for a long time. They did it. I recently read the book 1929. Great tale of people dismissed retail investors then, and there were some people back then who fought for retail investors, but many more people who looked down on them, fleeced them, mistreated them. I think what's new, and it's new across society, right? It's not just in investing; it's in many other fields. Some of them even more important than investing. People can and do organize themselves. The ability to communicate, find like minds, and then take action. I mean, the story of Wall Street bets and what happened with GameStop is, I think, the marker in a lot of people's mind. But that was obvious to me from my front row seat. It was obviously going to happen because people, whether it's our products or other products, people can and do talk about products. And that's always been true, that you've always had like bulletin board services where investors get together, but it's on such a broader scale now. And so many people are oriented to the idea that we can organize and communicate and share ideas and take action. That's a societal force that's shown up in investing. And I think, is investing a level playing field? In many respects, no, it's not, but it can be, right? And people are trying to force it to be. And I think they have leverage against that. And I think that's pretty exciting. And that's only growing. Like people now in the alternatives industry, people do take the retail investor seriously in the sense that they know that they're a force. I think they're mistaken about how to serve the retail investor and what the retail investor actually requires. And there's going to be sort of some rude awakenings in the asset management industry about that in the coming decade. But if there aren't already, I'm already seeing class action lawsuits against some of the BDCs, and there's a bunch of stuff that's happening on some of these non-traded products. So I think we may yet see more of that. But retail investors are a force. I've witnessed how over the last decade, 12 years, they've become more of a force. I'm, of course, cheering that because I've been on the sidelines as a hobbyist for even longer than this decade, right? For several decades.
Let me learn more about that. With this investor base maturing, what are they demanding now that simply did not exist 10 years ago?
Well, they want accountability, right? They want to know where is their money going. They want transparency into where their money is going. They want accountability for where the money is going. They want to know that they're being treated fairly in the marketplace, that they're not being disadvantaged. I think it's shameful what some of the asset managers have had to do, where even some of the largest asset managers in the world in this space could not meet their minimum redemption requests, did not have enough liquidity to do it, and did not want to sell assets, which then would force them to mark the assets down. So they went off and in one famous case, I won't say who it was, look it up. They went off and raised money from the Saudis and put them in a liquidation preference stack above all the retail holders, right? People are going to see that. They're going to talk about it. They're demanding accountability for it. And I think they're demanding value. So I think they're more savvy, they're more exacting, and they're more intent on holding everyone accountable. Is it painful to me as an issuer when investors hold us accountable and ask hard questions? They drive by our properties and they say, this isn't actually a property that's being developed, and they usually have it wrong. But sometimes they're right. Sometimes they see something we don't see. And most people in asset management hate that. They can't stand that. I personally think it's wonderful and part of what makes investing interesting and a fun avocation.
One thing I do enjoy about it is that, the traditional analyst role reviewing deals is ultimately been replaced by the retail crowd themselves to be able to take a look at a deal at mass and nitpick all the flaws in it. It's fascinating.
There are a lot of armchair analysts out there who find things that the pros don't. It's kind of cool. It's a big world, with a lot of different diversity of thought. And I think that's exciting. I think you're right. People have more information. People are smart. And look, I also tend to think people are smarter than the industry gives them credit, for being. I've seen that. We don't underestimate our investors.
Ground Floor has surpassed more than 1.8 billion invested through your platform. Congratulations. That's a significant number.
That number, when I look at it, we're pretty proud of that.
You should be. I'm proud of that. What does that scale reveal about the appetite for private market investing right now?
Well, I think we're really in the early innings of private market investing. We're still defining what private market investing means. We're still dealing with questions about how it should be formatted, how it should be managed, how it should be distributed, right? These are very important questions that the public markets were, as the public markets would think about, expanding retail access in the 80s, in the 90s, these were similar types of questions that were happening that were being solved in those markets. We're going through a period now where those questions are being confronted. And I think that's exciting. So when I look at the early demand, I still think it's small. I actually still think it's a very small business relative to what it will be in the future. And what interests me as an entrepreneur is, how does the combination of product and distribution come together in the next decade or two to create a generationally important company and platform? And can we be that? Are we a valid contender? I think we are, but we have to continue to earn our place with our customers first and foremost.
How do you see this growth signaling where the market's heading next, and what new challenges are you expecting to come with it?
Well, there's gonna be a valley of despair, in private market investing. If you look at private credit, it's already happening, right? There's going to be recriminations and a lot of gnashing of teeth around, people that got involved in interval funds, and now are getting crushed. There's going to be a comeuppance around fees and how some of these products actually performed. I think that's going to be painful for the industry. People will question, but are retail investors actually going to, invest in this, long term? They will. It just needs to come in a format via a channel that they will accept, right? And that ground is going to be heavily contested in the next decade.
Viewing all investors the same just clearly isn't going to work.
No, I don't think so. Here's a simple example.
Okay.
If you told me that I could invest in tech stocks, but in order to do it, I had to invest in your fund offered on your platform, and I had to pay X amount of fees, and I was locked up for a certain period of time, and it was for my own good, by the way. It's for everybody's good. that's participating, I'd be like, what are you talking about? I want to buy NVIDIA and Amazon and whatever I want, and I want to buy it fractionally. I want to buy 0.15 shares of NVIDIA and zero point 0.1 shares of Amazon, and then I want to trade it, and I want to rebalance it whenever I want, and I'm not going to pay any fees, right? That's what people think. That's how they've been conditioned in the public markets, and if they're not doing that, then they're investing in low-cost index funds that they're not paying much for either and have a lot of liquidity. So that's the benchmark. And, there are real ways in which private markets may or may not be able to meet that, but it has to resemble that. And the incumbents are unlikely to offer product that's formatted that way. I think it's companies like Ground Floor and some of the people in our, in this cohort of company, that it's the same reason that, Merrill Lynch didn't become, in the early days, Schwab crushed Merrill Lynch in retail investing, right? Like Merrill Lynch was not the winner, right? I mean, when the SEC deregulated fees, Schwab was scared that, Merrill was going to cut commissions and crush his business. That's not what happened. Merrill raised prices. And Schwab was like, oh, okay, great. He had a business after all. So I think the incumbents are unlikely to get it right. They're showing signs already that they're not going to get it right, that they aren't getting it right. And I it's up to the entrepreneurs among us to go, take the field.
Brian, you often compare today's moment to the early days of the index funds, back when people thought the model was too radical. What parallels do you see between that era and what's happening in private markets now?
Well, I think if index funds the history of index funds is interesting. It was actually a wealth management unit out of Wells Fargo, surprisingly, that put forward the first index fund. I think it was in the 50s or 60s, memory serves. And it was before Vanguard did it and before any of the people that we all think of did it. And I think that innovation came from an academic foundation, right? And people doubted the practicality of it. And people, there was almost like a religious fervor against it, from practitioners in the field. So sort of like academics against practitioners.
Okay.
If you look at what's happening today, I think, is there an analog to the debate between, efficient market hypothesis and, portfolio theory, construction theory? I think what's happening is people are going to say, I can't be at zero in alts. I need to be allocated somewhere. That's, if you're a family office or you're a high net worth investor, that's what you're being guided to do. The question for everybody is, what's your allocation and how are you going to allocate it? And I think the analog between the advent of index funds and what's happening today is people are looking for the vehicle that opens the mass market for this, right? Ground Floor, when we launched, we would offer sort of 5 or 6 loans per week for investment. They would sell out in less than a day, some days less than an hour. It was like no way to run a business, right? Not a proper investing business, because you're always like supply constrained. You're just trying to get more to sell to people. Well, we solved that problem. We got to be big enough. Then it became a lot of work for people to sort of pick and choose deals and build their portfolio. So we tried to build tech, to allow people to do that. Okay, well, now you've got tech making it easier. Ultimately, we've arrived at vehicles and structures that put that tech to work for people once they believe in it, but we give them the freedom to choose how they invest. I think those are the sort of things that happen with index fund investing, right? Individual stock investing, fractional investing in individual stocks, right? Like you start to look at how that came together, and that starts to give you a picture of how it could play out here.
What needs to happen in regulation, technology, or investor education for private market investing to become a highlighted Main Street financial path?
Well, in regulation, the rules made significant strides forward in 2012 and in the years after that when the SEC kind of put those rules in place. We need to continue to, examine those rules, expand them. There are real ways in which people have to, people like us have to go be a case of first impression or to show how the rules could be applied. I think now that we've patterned some of that, I think some of the rules need to evolve again to accommodate what works in a lower cost, sort of more issuer friendly kind of construct. I think it'll be interesting to see whether, whether the law gets to work on something like that in the coming years. I suspect some of what's happening with interval funds and retail investors may generate some of that. I mean, there could be popular outcry and hearings in Congress, and that kind of thing that sort of gives us some of the seeds of that. I think in investor education, I think in general, although people are smart, which means they have the capability to learn, they're also busy. And at the end of the day, any hobby can quickly become boring for most people after some period of time. And so you have to find a way to engage people enough so that they feel confident. Nobody wants to feel stupid when they come to their money. So we're exploring ways to help people feel confident about what they're doing, but then set it and forget it, and then be able to kind of get involved again when they're ready to, right? And when they're inclined to do it. So I think respecting that people are smart enough, but the real challenge is that they're busy and you're competing for attention. That's kind of interesting, because if you're saying, hey, look, this is going to be higher involvement format, well, you have to have enough space and time and inclination for people to get involved, right? So I think those are some of the interesting development. Like in investor education, I think some of that's starting to happen in alternatives, but these are slow moving, trends typically.
As far as regulation goes, are you looking for changes in what it takes to be a accredited investor, changes in exemption amounts? What's if you're on Santa Claus's list, what are you asking for?
Look, the problem with everybody railing against the definition of accredited investor, look, we can draw the line or set up whatever criteria we want. The real problem with that is what's required of the issuer once you meet the hurdle, and the answer is not much. You basically file a form to say you did an offering, and it's a notice filing. It doesn't get reviewed. They're subject to no scrutiny. And so if you ask me, patterning the world after Reg D exempted investments is not the path forward. The path forward is making it easier and cheaper to meet public company style disclosures, and to make that more economic, right? And so there are certain cost components that relate to the lawyering that's required.
It's an expensive path to get to that level of risk disclosures.
We were a case of first impression, so it's not a good measure, but it took us $2 million and 4 years to get our regulatory footing, right? Really. We still spend a lot on rate. We've amortized the cost and we've kind of gotten over the hurdle. But if you talk about, fostering innovation, having a lot of issuers, there are not a lot of issuers who are willing to do what we did. I can count them on one hand, over 12 years. And not all of them were successful. There have only been 2 or 3 that have been successful at any level. Many of them have had to totally change their model. And so if you really want dozens of issuers competing and innovating across lots of different spaces, you need to lower the hurdle, not by lowering disclosure, but by making disclosure less expensive and making review less expensive. And creating allowing for a greater quantum of capital. Like our Reg A offerings are limited to 75 million each. Right, that creates some friction for us in managing multiple offerings, right? That's increased from what it used to be, right? It used to be 50 million, and before that it was 10 million, right? Before that was 5 million, right? So we need to keep moving that up as the market grows. That'd probably be number 1 on my list is,
okay.
Reg A offerings should probably be $250 million, right? Not 75.
That'd go a long way.
Yeah.
Towards solving the purpose of the Jobs Act. It really would go a long way.
I think it would. Yep.
You mentioned using specific structures to help out a couple of questions ago. What type of structures are you putting in place is it to assist the investors or to assist the issuers with the investors on the cap table?
So the issue is people want liquidity, but they don't want to be subject to the vagaries of net asset value on a fund, right? So the disruption of the fund is happening in real time. The question is, how can you get to the benefits of having fun, which is a lot of diversification and liquidity, without trapping people into a structure, right?
Okay.
And so what we've experimented with, our Flywheel portfolio is a good example of this. And we're not nearly done productizing this. We have a lot more work that we want to do to make it better and better. But what's great about the Flywheel is that it is the closest you can get to investing in hundreds of loans, a portfolio of hundreds of loans in waves, right? That are constantly refreshing. And you have a lot of optionality, right? We're the only issuer of a product of this type that when we get repaid on a loan, so we make a loan for a house, right? We get repaid on the loan. We return the capital to the investors who are invested in that loan. Whether you've invested in it as an individual issuance on our platform or whether you've invested in it via our Flywheel, you get your principal and interest back. Now, most people, 85% of the capital is just automatically reinvested because people are building their snowball. But if you want liquidity, you can take liquidity and you can use our system to say, I want liquidity up to a couple $1,000s and then continue reinvesting. And then we have these other products like our ground floor notes that allow you to go invest that liquidity on a defined term. You earn a lower return, but you get it back in a month or 3 months, or 12 months, depending on what you're choosing. And I think that sort of construct is going to work really well. The combination of something like our Flywheel product and the combination of our notes product, both of which are now over $100 million in AUM. They're both significant products in this space. Not many people have products that are over 100 million in AUM that are formatted this way for the retail investor. So I think that's what I'm talking about. I'm talking about structures like that, and even accepting that ours is still imperfect, right? There's still innovation to be done, right, as we continue to work on that.
I like to end our episodes with something light. Can you share a story or a moment from your journey building Ground Floor that still makes you smile or might surprise someone if they heard it?
Oh, yeah. So the story I like to tell is how we funded our first loan. And it's funny because when we subscribed the loan, we had built the website to collect subscriptions, but we had not built the pipes. We knew the API and we knew the vendor, but we had not built the pipe to actually collect the money. So we were kind of like the dog that caught the car, right? So there was a chain of events that started with, okay, great, now we've collected enough pledges to fund this first loan. And it was like $40,000, right? It was not a lot of money. But number one, we did that. We did the next one the next weekend, by the way. So now we had like $80,000 we had to go collect. And we had to build all the software, to interface with the API, for ACH. Then we had to go to investors and say, hey, on this thing you pledged, we had to call them up and get them to, they're like, what? I kind of forgot what this was. So that was comical. We had actually Anthony Pompliano, who's now famous in the Bitcoin world, was actually a part-time contractor for us and led kind of our boiler room in Raleigh on Fayetteville Street. So Pomp was in there rallying the troops, the interns, to help us collect. And then the funniest thing is when we finally got the money, we weren't set up with our financial infrastructure in a way that allowed us just to disperse the money to the borrower who was waiting for it. I actually had to take a cashier's check from one bank and walk down Fayetteville Street with this $80,000 check and deposit it in this other bank. And I was like, this has been a lot harder than I hope it's going to be.
I love it.
It was humbling. But at the same time, I was kind of proud. It's like, hey, here's $80,000 of my investors' money. We're depositing it here. We're going to put it off. We're going to, close the deal with the borrower. And so it was kind of a funny sort of 6 weeks in the company's history back in 2014 that I kind of love reliving, actually, now that we're where we are.
Completely nice, rewarding moment. Brian, thank you for sharing your vision and your story behind what you're building. Your work shows how private market investing can expand participation, create access points, and reshape how everyday people think about generating returns outside traditional markets. Folks, if you enjoyed this episode, subscribe to Planet Wealth on YouTube or your favorite podcast platform. We'd love to hear your thoughts in the comments. I'm Lance Woodson. Thanks for listening to Fortunes of the Brave.